And breaking news in the last few minutes, the Bank of Canada has cut its key interest rate once again. The central bank reducing its overnight rate by another 25 basis points, or a quarter of a percent today, now bringing it to 4.5%. The move follows another 25 basis point cut last month. Forecasters had largely been expecting the bank to slash the rate today, saying slowing inflation and a weaker economy justified another cut. Now, for more on the central bank's decision, we are joined live by Alan Small, Senior Investment Advisor with Alan Small Financial Group. Alan, we do appreciate you always being in studio, helping us break this down. This was essentially signaled and telegraphed not only by Tiff Macklem, but also just looking at the key indicators. 2.7% was what we saw at least the headline inflation rate in June. Is this good news, and is it going to be enough for those that need it?
Well, that's a great question, and my take on it has been that we're going to need to see a few more of these types of cuts before I think people start to feel different, right? You know, you've had two 25 basis point cuts, 50 basis points, so prime rate was 7.2, now it's 6.7. Is that going to be enough to get people off the sidelines, maybe moving back into the housing market, looking for a house again? Not so sure, right? Mortgage rates are still pretty high. I think you're going to have to see a couple of more cuts before we actually start to feel a difference, maybe setting us up for a very hot spring buying and selling season.
And just in terms of getting potentially to a spring like that, we're at 4.5% now, and we saw the interest rate go up and up and up. But all of that came on the heels of things like an oil crisis coming from Russia invading Ukraine. How close, if we have another destabilizing global event like that, is there any way that the inflation rate could still go down?
Well, it can go down and it can go higher, right? The hope is that it will continue to fall, but at the same time, we're seeing the economy weaken. So those two, unfortunately, go hand in hand usually. And at some point, central bank, like they're doing now, Bank of Canada, steps in to cut rates to hopefully start to stimulate again. They don't want to let things get too slow or perhaps fall into some sort of mild recession before they cut rates. So they cut rates in anticipation of a slowing economy. And also, we've been hearing from them quite a bit lately about productivity, with all the people coming to this country. And when you take a measure of productivity on a per-person basis, productivity in Canada is quite low. So when they see productivity levels low, when they see inflation falling, and the overall economy slowing, that's a signal for them that they need to cut rates. Now, they've cut twice in a row. Will they cut 3 times in a row? Probably unlikely, if I had to say, at this point in time. And the other thing to keep in mind is, what is the Federal Reserve going to do down south? If they don't cut rates, I don't think they're going to cut in July, but if they don't cut in September and they continue to stand pat and not cut until December, what does that mean for our Canadian dollar? And a weaker Canadian dollar could also be inflationary if it stays quite weak versus the US dollar over time. So a lot going on, I think, for the Bank of Canada to parse through, to think about. And the question will be, can they continue to cut if the Federal Reserve in the U.S. does not cut?
And you were also talking about the potential of not having another rate cut once we hear from the Bank of Canada, I believe in August. Now, if that's the case, thinking about this, is this why, when we hear from Macklem, he's saying not doing too much too quickly because that could just re-trigger inflation?
Absolutely. And the last thing they want to do is cut, only to raise, a couple of quarters from now. I think it's got to be gradual. The last thing they want to see is an overheated housing market once again. That is, in my opinion, their biggest fear. So they're going to cut, but they're going to take a measured approach, follow the economic data, see how the economy is doing, and then adjust accordingly.
Well, I guess we're going to have to adjust when we talk to you next, because we'll have to see how things go the next couple of weeks, and then I guess we'll be reconvening right here at some point.
Absolutely.
Alan, we always appreciate your time. This, of course, Alan Small with the Alan Small Financial Group, and we do, once again, appreciate your time.
Thank you.